A decade ago, the average American bought their first home in their early 30s. Today, that number is 40 years old. Let that sink in. An entire generation has been pushed a decade behind where their parents were, and the financial cost of that delay is staggering. Waiting 10 extra years to buy a typical starter home can cost you $150,000 in lost equity. That's not a minor inconvenience. That's a retirement fund. But here's what the headlines aren't telling you. 2026 may actually be the most realistic entry point in years if you know what to look for and what to avoid. The rules have genuinely changed, and the buyers who understand those changes will have a real advantage. I'm going to give you the 5 questions to ask before you buy a home in 2026. These aren't basic tips you've heard before. These are the questions built specifically for this market, this economy, and the new landscape that most buyers don't even know exists yet. Welcome to Quick Financial Concepts, where we help you make smarter financial decisions by asking the right questions first. Hit subscribe so you're ready when that moment comes, because in real estate, timing and preparation are everything. Let me give you the 90-second picture of where the housing market actually stands right now. Not the panic version, not the overly optimistic version, just the facts. The good news: inventory is up about 20% compared to recent lows. Home price growth is essentially flat in 2026. Prices aren't crashing, but they aren't running away from you either. Sellers are negotiating again. That is a significant shift from the last few years. The complicated news: the 30-year fixed mortgage rate is hovering between 6.3% and 6.5% right now. Most forecasters do not expect it to drop below 6% anytime soon. If you've been waiting for rates to come back to 3%, that window has closed, and waiting for it could cost you years of equity building. The new developments. In March 2026, President Trump signed Executive Order 14393, directing federal agencies to expand access to mortgage credit, ease regulatory burdens on community banks, and push Fannie Mae and Freddie Mac to purchase an additional $200 billion in mortgage-backed securities to drive down borrowing costs. Congress is also debating first-time homebuyer tax credits that could put up to $15,000 back in your pocket at closing. We'll talk about both. This is a market full of moving parts. These 5 questions will help you navigate it clearly. Question number 1. Can I actually afford this? Or can I just qualify for it? This is the most important distinction in the entire home buying process, and almost nobody talks about it. Qualifying for a mortgage means a lender looked at your income, your debt, and your credit score and decided you're eligible to borrow up to a certain amount. That number can feel exciting. It can also completely wreck your financial life if you treat it as a target instead of a ceiling. Here's the real math you need to run. Take your total monthly housing cost, mortgage principal and interest, property taxes, homeowner's insurance, and HOA fees if applicable. And make sure it does not exceed 28% of your gross monthly income. That's the threshold most financial planners use. Many lenders will approve you well beyond that. That's their business. Protecting your financial stability is yours. In 2026, with rates at 6.3% to 6.5%, a $350,000 home with 10% down produces a monthly payment of roughly $2,100 to $2,200 before taxes and insurance. Run that against your income. Then run it against your actual monthly expenses, not your theoretical budget, your real one. What to do? Before you talk to a single real estate agent, sit down and calculate your true comfortable payment ceiling. Build your home search around that number, not around what a lender pre-approves. Question number 2. Do I understand what Trump's mortgage credit order actually means for me and what it doesn't? This is getting a lot of attention right now, and there's a lot of confusion about what's real and what's still a proposal. Here's what is actually in effect. In March 2026, President Trump signed an executive order directing the CFPB to simplify mortgage rules for smaller community banks, meaning more lenders may be able to offer you a mortgage, potentially with more flexible terms. The order also pushes for modernized appraisals, faster digital closing processes, and expanded access to mortgage-backed securities funding, designed to put downward pressure on rates over time. What that means for you as a buyer: more competition among lenders is generally good for borrowers. Shop multiple lenders, including community banks and credit unions that may now have more flexibility than they did a year ago. Don't just go to one bank and accept their offer. Here's what is still a proposal and not yet law. Congress is debating a first-time homebuyer tax credit that could return up to $15,000, or in one version, up to $50,000 to qualifying buyers. That legislation has not passed. Do not make a financial decision based on money that isn't in your pocket yet. Track it, watch for it, but plan without it. What to do? Ask every lender you speak with. What programs are available to me under the new 2026 Mortgage Access Guidelines? That question signals you know what's happening and opens doors that a passive borrower never finds. Question number 3. Is my income stable enough to survive this commitment for the next 5 years? This question carries more weight in 2026 than it has in a very long time. Here's why. AI-related job disruptions are accelerating in white-collar industries. Unemployment is edging up, and nearly 60% of Americans say concerns about AI's impact on their job security are affecting their confidence in buying a home. That anxiety is not irrational. A mortgage is a minimum 5-year commitment if you want to break even on closing costs and build meaningful equity. If your industry, your company, or your role is in a zone of disruption right now, that timeline is a real risk factor, not something to dismiss. This doesn't mean you shouldn't buy. It means you need to buy with your eyes open to the reality of your job security. What to do? Before closing, make sure you have a financial cushion of at least 3 to 6 months of mortgage payments sitting in savings separate from your down payment. That buffer is your insurance policy against income disruption in a volatile job market. If you can't build that cushion alongside your down payment, the timing may not be right yet, regardless of what the market is doing. Also, if you have a partner buying jointly, calculate whether either income alone could cover the mortgage in an emergency. If the answer is no, that's critical information. Question number 4. Have I shopped this market like a negotiation, not like a competition? For the past several years, buyers had to approach every purchase like a bidding war. Multiple offers, waived contingencies, offers over asking price. That was the reality. That market has meaningfully shifted in 2026. Inventory is up 20%. Home price growth is flat. Sellers who listed expecting the old frenzied market are sitting longer. That means you have negotiating power that didn't exist 18 months ago, but only if you know how to use it. Most buyers still behave like it's 2022. They rush, they waive inspections, they overbid out of fear, and they pay for it. What to do? First, never, I'll say it again, never waive a home inspection to win a deal in 2026. An inspection protects you from buying someone else's problem. In a normalized market, no serious seller will walk away over a reasonable inspection request. Second, ask your agent for the average days on market for comparable homes in the area you're buying. If homes are sitting 30, 45, or 60 days, the seller is likely motivated. That's your opening to negotiate on price, closing costs, or repairs. Third, request seller-paid closing cost concessions. In a buyer-friendly market, many sellers will accept a slightly higher purchase price in exchange for covering your closing costs, which can effectively reduce your out-of-pocket cash needed at the table. Question number 5. Am I buying a home, or am I buying a financial plan? This is the question that separates long-term winners from long-term regrets in real estate. A home is not just a place to live. For most Americans, it is their single largest financial asset. That means the decision of what you buy and where you buy it has compounding financial consequences that last for decades. Ask yourself, is this neighborhood growing or declining? Are property taxes trending up in ways that could strain my budget in 5 years? Is this home in a flood zone or climate risk area that could affect my insurance costs or future resale value? Does this home have features, square footage, school district, commute proximity that will appeal to the next buyer, not just to me today? And critically, are you buying based on where your life is today or where you realistically expect it to be in 5 years? A one-bedroom condo might make perfect sense right now. It may be a financial anchor if you start a family before you've built enough equity to move. What to do? Before making an offer on any property, write down a 5-year ownership scenario. What does your life look like? Does this home fit that picture? If you struggle to answer confidently, the home or the timing may not be right. Today's final thought. Here are your 5 questions before you buy a home in 2026. 1. Can I actually afford this, or can I just qualify for it? 2. Do I understand what Trump's mortgage credit order means for me and what it doesn't? 3. Is my income stable enough to carry this commitment for the next 5 years? 4. Have I shopped this market like a negotiation process, not like a competition? 5. Am I buying a home or am I buying a financial plan? This market is more navigable than it's been in years, but it rewards the prepared buyer and punishes the emotional one. If this helped you think about home buying differently, do me one favor. Share this video with someone you know who is thinking about buying in 2026. One conversation could save them from a decision they'll spend years recovering from. Subscribe if you haven't already, and drop a comment below with this. Are you planning to buy in 2026, or are you still waiting? Tell us why. We read every comment, and your answers shape what we cover next. And remember, getting approved for a mortgage means a lender believes in your ability to pay. Buying the right home means you believe in your financial future. Those are 2 very different decisions.